Section 1:1 Understanding Sector Rotation. 1.1 Introduction to Sector Rotation. Sector rotation is an investment strategy that involves shifting the allocation of investment capital across different sectors of the economy based on the anticipated performance of those sectors. It is a systematic approach to adjusting portfolio holdings to take advantage of changing economic conditions and market trends. The importance of sector rotation in portfolio management lies in its potential to enhance returns and manage risk. Here are a few key reasons why sector rotation is important. Diversification. Sector rotation allows investors to diversify their portfolios across various sectors. Different sectors tend to perform differently at different stages of the economic cycle. By diversifying across sectors, investors can potentially reduce portfolio volatility and avoid concentration risk associated with overexposure to a single sector. Capitalizing on market trends. Different sectors of the economy may outperform or underperform at different times due to various factors such as economic indicators, market cycles, or industry-specific events. Sector rotation enables investors to capitalize on these trends by reallocating their investments to sectors expected to perform well in the current market environment. Risk management. Sector rotation can be used as a risk management tool. By monitoring economic and market conditions, investors can identify sectors that are likely to be more resilient during market downturns or economic contractions. Shifting investments to defensive sectors or sectors with lower volatility can help mitigate downside risk and protect the portfolio during turbulent periods. Potential for outperformance. Successful sector rotation strategies aim to allocate capital to sectors that are expected to deliver superior returns. By identifying sectors with favorable growth prospects, strong fundamentals, or positive catalysts, investors can position themselves to benefit from potential outperformance in those sectors, thereby enhancing their overall portfolio returns. Adaptation to changing economic conditions. Economic conditions evolve over time, impacting different sectors in various ways. Sector rotation allows investors to adapt their portfolios to changing economic conditions. For example, during periods of economic expansion, cyclical sectors like technology or consumer discretionary may perform well, while during economic slowdowns, defensive sectors like utilities or consumer staples may exhibit more stability. It's important to note that sector rotation requires diligent analysis and research to identify potential sector trends and select appropriate sectors for investment. It also requires regular monitoring and adjustments as market conditions evolve. Successful sector rotation strategies rely on accurate and timely assessments of economic and market factors to make informed investment decisions. However, it's essential to remember that sector rotation involves market timing, which can be challenging to execute consistently. Investors should carefully consider their risk tolerance, investment objectives, and consult with financial professionals before implementing sector rotation strategies in their portfolios. The rationale behind sector rotation as an investment strategy is based on the belief that different sectors of the economy go through distinct phases of performance over time. Sector rotation seeks to take advantage of these cyclical or rotational patterns by allocating investments to sectors that are expected to outperform in the current market or economic conditions. Here are some key rationales behind sector rotation. Economic cycle sensitivity. Different sectors of the economy have varying degrees of sensitivity to the overall economic cycle. During economic expansions, sectors such as technology, consumer discretionary, and industrials tend to perform well as consumer spending increases and businesses invest in growth. In contrast, during economic downturns, defensive sectors like utilities, consumer staples, and healthcare may be more resilient as they provide essential goods and services. Sector rotation aims to position the portfolio in sectors that are expected to benefit from the prevailing economic conditions. Market leadership changes. Market leadership can shift over time as investor sentiment changes or new trends emerge. Certain sectors may lead the market during specific periods, driven by factors such as innovation, regulatory changes, or shifts in consumer behavior. Sector rotation seeks to identify these shifts in market leadership and adjust portfolio allocations accordingly to capitalize on potential outperformance. Valuation opportunities. Different sectors may experience periods of overvaluation or undervaluation based on market conditions, investor sentiment, or sector-specific factors. Sector rotation aims to identify sectors that are attractively valued and have the potential for future price appreciation. By rotating into undervalued sectors and avoiding or reducing exposure to overvalued sectors, investors can potentially enhance returns and manage risk. Diversification and risk management. Sector rotation provides an opportunity for portfolio diversification across different sectors. By spreading investments across sectors, investors can reduce concentration risk and minimize the impact of any single sector's performance on the overall portfolio. Additionally, sector rotation allows for risk management by adjusting sector allocations based on the assessment of potential risks and opportunities in the market. Active management and alpha generation. Sector rotation is a strategy that requires active management and ongoing analysis of economic and market trends. It provides an opportunity for skilled portfolio managers or investors to generate alpha, excess returns, by identifying sectors that are expected to outperform or by timing the shifts between sectors effectively. It can be particularly beneficial in environments where sectors exhibit pronounced divergences in performance. It's important to note that sector rotation requires thorough research, analysis, and monitoring to identify potential sector trends and make informed investment decisions. It is not without risks, as accurately predicting sector performance can be challenging, and there is a risk of mistiming rotations or overreacting to short-term market fluctuations. Investors should carefully assess their risk tolerance, investment goals, and seek professional advice before implementing sector rotation strategies in their portfolios.